Okay, it's time for 5 of my favorite articles from February. We are starting with Ben Franklin and his 200-year-old gift to the cities of Philadelphia and Boston. It's really interesting. I didn't realize this until this last month. So in 1790, Ben Franklin put in his will that he was leaving $2,000 in today's money. It was worth a lot more back then. 2,000 each to Philadelphia and Boston, but it came with some stipulations. They were going to create a trust, and the rule was going to be for the first 100 years that money could be used to loan money to apprenticeship programs. And then after 100 years, then 75% of whatever that had accrued to could be used for public works. And then 25% would have to remain invested for the next 100 years. And then in 1990, then the cities would finally be able to utilize the money in whatever way they deemed fit. Well, over that 200-year process, the money was used pretty close in line with Ben Franklin's outlined wishes. The problem was things change, and it's hard for Ben Franklin to know exactly how the U.S. and its economy would shift over time. By 1890, apprenticeships were pretty much a thing of the past. The American economy had shifted so drastically. There was also some litigation that happened in late 1800s and the mid 1900s where lawyers and those in the city said, these parameters that the trust gives are too cumbersome. We need to be able to loosen up the restrictions. And so along the way, a lot of that money, like he had said, 75% could be used for public works, and they did use, the majority of that money for public works. But some money did get invested all the way through, and I was really curious to know how much did that turn into? So that $2,000, $4,000 combined investment by 1990 had grown to $6.5 million, which is certainly does not chump change, but for cities like Philadelphia and Boston, probably didn't make a huge dent in their yearly budget because they're such huge cities. And by 1990, $6.5 million, still a lot of money, but still pretty small comparatively. But what I was thinking was, and of course, and the other thing too is, of course, there was a lot of benefit received along the way, and it's hard to put a price tag on all those things and what they were worth. So what did the total investment turn out to be? I don't know if there's a good way to put a number on that. But what it got me thinking is the power of uninterrupted compound interest. Like, what would that $4,000 investment have turned into in 200 years if they couldn't touch it at all? If Ben Franklin had said, nope, it's in a lockbox, can't use it for anything until 1990, how much money would have been in there? If it had earned a 7% return, it would have been north of $5 billion. If it had gotten a 10% average annual return, unlikely, I think, over that time frame, because they would have probably had a little bit more of a balanced investment portfolio, because it's because it's designed to be more of a longevity, more of a kind of an endowment fund type of approach. But if it had gotten 10% average annual return, it would be not $5 billion, but $5 trillion. So it got me thinking, maybe this is our way out of our national debt problem. What we need to do is put some money aside and say you can't touch it for 200 years, and then in 200 years we won't have any debt problem anymore. I don't know if we'll make it the next 200 years, but that's just an idea for you. Okay, so anyway, if you want to read that entire article, it's on Mental Floss. By the way, if you're not getting the monthly articles, you can send me an email, info@nateskelly.com. I'll add you to that list. I just send a few of my favorite articles from the previous month out one time a month. Next article is on how to negotiate your salary. It's by Calzimuse, I think is how you say it. I don't know anything about this blog or the writer. I don't even remember how I came across it, but I thought it was really, really good, very valuable. It's about how to negotiate your salary. It's written particularly with engineers in mind, but reading the article, it doesn't really. This could be for anybody. It doesn't have to be just for engineers. And what he does in the article is just outline some of the most helpful techniques and helpful principles to keep in mind when it comes to salary negotiation. First and foremost being, don't undersell yourself on the benefit, the long-term benefits of a salary negotiation. I think a lot of people, just because it's uncomfortable, you kind of feel like I'm digging in my heels, I'm sliding the paper back and forth across the table. I don't want to be adversarial. I don't like the uncomfortability of negotiation. So people give in, or they don't even try to negotiate for themselves. But think about how much impact that can have over time. A 5% or 10% increase in your salary, that's weeks of extra pay that you're getting. And not to mention 401k and the long-term compounding benefits and even just other benefits associated with healthcare and pay time off and those types of things. So Don't sell yourself short. Realize the impact of negotiation. And he just outlined some practical things to keep in mind and some practical things to do in these conversations, whether it's with a new employer or with your current employer. And one of the big things is make sure you shift your mindset. Good negotiation is not done in an adversarial sort of like, we've got one pie and we're arguing over, we're going to split this 50-50, or if I'm going to get 60-40, or, no. Be collaborative in your approach. Hey, we're on the same side of the table. We both want the same thing, and that is for me to thrive in this position and to bring much more value to the company than what you're compensating me for. So let's find a win-win solution in all of that. So being collaborative in your approach and in your tone goes a long way. Another just simple practical thing that he talks about is don't be the first one to discuss salary expectations. A lot of times the employer is going to want to ask you, what are your salary expectations? What were you paid at your previous job? What are you hoping to get from this job? And get you to throw out a number first. Always let the employer make the first offer. They're the one who is in the position of considering hiring you, so therefore let them tell you the number they think is commensurate with your skills and expertise and experience. And if you are going to throw out a number, go high. It's better to anchor the conversation to a number above what they were going to be willing to pay in the first place than to put something too low. Come prepared with data, with industry standards to justify any salary requests. And another great thing that he talks about, and this is not all of it, there's much more, it's a longer article, but well worth your time, is to negotiate not just your base salary, but think about your benefits, bonus, vacation days. Sometimes people just concentrate on the salary, and that might be set at a corporate level, so there's not as much wiggle room. So they say, hey, the ceiling on this job, it's $80,000. We literally can't go any further than this. It's as much as HR will let us offer for this position. Well, okay, but maybe there's wiggle room on PTO. Maybe there's wiggle room on stock options or other different types of benefits that might be at play. So think about your entire compensation package. So another great article, especially if you're thinking about having a conversation with your employer or a new employer anytime soon. Now, these next two articles are an opportunity for me to get a little bit on my soapbox. I'll tell you this right now, I am not somebody who does a very good job or even likes to brag on my own profession or talk about myself. If anything, if you're talking to me about a financial planner, I'm probably going to try to downplay my expertise or my value. I hate doing anything that even seems close to bragging. But I'm trying to get better at it, and these two articles this month are going to help me to do that. I'm going to jump up on my soapbox a little bit. I'm going to rant. So hope you're along for the ride with me. I've seen increasingly, and maybe this is just because I'm plugged into the financial advice space and I'm just much more aware of it, but maybe you've noticed it too. I've noticed some increasing the attitudes towards investment management, working with a financial planner, are starting to shift a little bit in two particular areas. So the first article I wanted to highlight, this is comes from Meg Bartlett. She is the owner of Flow Financial Planning. Great article on this idea of when you might want a professional to manage your investments and why that might be a good idea. There's an increasing idea or attitude out there that, hey, you don't need an investment professional. It's not hard. Put your money in the S&P 500, buy an index fund, call it a day. That's all there is to it. And there's a part of me that wants to say yes, and a big part of me that wants to say, but no. And the part of me that says yes is, I think it's great that people are shifting away from trying to pick their own stocks or putting their money in actively managed mutual funds that have high investment or high fees and have a long history of underperforming the market. So on one hand, I'm glad that people are catching on to this idea that passive investing is almost always a better way to go. But I'm saying no in the sense that people are also not realizing what a real investment professional, a good, comprehensive, proactive financial advisor can do for you. And I think, and I've seen this a lot of different places, this sort of this comparison of saying, hey, if you put your money in an S&P 500 index fund and it gets 8% average annual return a year, but then if you work with an advisor that charges 1% AUM, well then you'd have this with the index fund, but you'd have way less with the advisor with the 1% fee because you'd only be getting 7%. And it's like, that's such a ridiculous comparison because you are assuming that the financial advisor added zero value, that the person made all the same decisions, did not get any value from tax planning, estate planning, cash flow planning, budgeting, insurance, Social Security, Medicare, got none of that, made all the exact same financial decisions, invested just as much money, bought and sold at the exact same time. Like, it's just not realistic. And while there is certainly a case to be made that for some financial advisors, what they are charging versus what their clients are receiving, there is not adequate value there. But I'm here to tell you, I know of many, many wonderful, great financial planners that are adding a ton of value, and I've seen it in my own practice, that are far exceeds whatever they've charged in fees over the lifetime of that relationship. So here are some things to keep in mind when it comes to working with a financial advisor. Why might it be a good idea to have a professional manage your investments? First and foremost, when it comes to investment management and making investment decisions, you probably want to do other things with your time, your energy, your brain power, your stress, your anxiety. Yes, if you love it, like if you absolutely love it and you want to go the deep dive, or you come from an investment background, sure, I can understand you saying, hey, I'd rather do this myself. But for most people, the vast majority of people, that's just something that they don't want on their plate, another thing that they don't want or don't need on their plate. But that's actually just the start. I would say that's even a smaller reason in comparison to some of these others. And that is an investment professional is going to be able to look beyond just, an S&P 500 index fund. By the way, if you just have your money in an S&P 500 index fund, okay, good, but there's still a lot of opportunity that you're probably missing out on. For instance, that would mean you'd have no money in small or medium-sized U.S. companies. It would mean almost all of your money, or a very, very large chunk of your money, is just in the tech industry, and that could be problematic. About a quarter to about a third of your money is in just 7 or 8 companies, and that also could be a problem. You don't own any companies outside the US, you don't own any bonds, and there's a lot of opportunities where you might be missing out on returns. There's a reason why 2000 to 2010 is called the lost decade, because if you invested in an S&P 500 index fund during that time, you would have made pretty much no money in that stretch, because the S&P 500 did very, very poor for 10 whole years. So, and because the S&P 500 has done so well here recently, people have bought into this recency bias of, well, that's all I need to do. I don't need to look anywhere else. Okay, but I'm building on this. These are not the only reasons. This is like a litany of reasons. Okay, also, why are you invested in the thing that you're invested in? I think most people, if I said, hey, why did you buy that fund? I don't know. I heard that it's a good fund. I looked at the list. Seemed to make sense. Sounds like growth. I think that's what I want. People don't usually really know why they bought what they bought. Another reason, making sure your money actually gets invested. A lot of times people have excess cash in their bank account, money that is not actually being allocated or put to use in somebody's best interest. A lot of times even within their own account. I can't tell you, there's been many times where I've looked at somebody's account and realized, hey, you got 30% of your money in this money market fund. And they didn't understand that it was a money market fund. They didn't understand that this money is actually in cash and not invested in the market. And that could be a huge drag on their return over time. But making sure that money gets invested regularly, whether it's a lump sum or doing dollar cost averaging. One of the biggest benefits that I provide for my clients is just making sure that they are actively and consistently investing on a regular basis. Because if they weren't working with me, it would be something that would easily kind of fall through the cracks, or they wouldn't be as proactive about it. But also understanding risk level. So I've seen retirees and their investments are aggressive growth, and it's like, what are we doing here? This doesn't make any sense. You're way too risky for your age range. And I've seen people in their 40s that they have all of their money in like government bonds, and they're way too conservative. They need to be more growth oriented. Sometimes people, hey, you put your money in S&P 500, sure, but maybe you need to have some of your money in bonds. Maybe you need to have some of that money in cash. What's the right mix? How much in stocks? How much in bonds? How much in cash? Making sure that people understand that they're at the right risk level. Another thing is rebalancing. How often do you reallocate and reshift that? How often do you change those percentages? How much do you have in international stocks versus US stocks? Large stocks versus small stocks. Rebalancing on a regular basis helps you to buy low and sell high, as certain funds, if they've done well recently, a lot of times that presents a good opportunity to sell that at a high and go ahead and buy other funds that have been doing poorly recently and being able to buy them low. Another thing is asset location. What types of accounts are you opening? Where are you putting your money? A huge difference can be, do you put money in a Roth account versus a traditional account? Do you open a taxable brokerage account? Do you do Roth conversions? What about tax loss harvesting? Did you know if you have a taxable brokerage account and you have funds that are at a loss, you might be able to sell them and then use those losses to offset gains and save yourself a lot of money on taxes? And some of those strategies that I just outlined have been able to save clients way, like being able to save them more money just on those moves alone, those tax moves, than they've ever paid me in fees for investment management. And on and on. Reporting, administrative work. A lot of times, I can't tell you. There's so many times where people are like, "Hey, I've been meaning to do this thing, and I just haven't gotten around to it because I don't understand what to do." Or I called them a couple of years ago and I didn't understand what they were telling me, and I forgot about it. And just even the simple things of making sure old 401ks get consolidated, making sure that contributions get made, make sure that accounts get rebalanced, or money that was in an account that's been sitting there for 7 years in cash actually finally gets invested. Open enrollment time, go helping people through their benefits through their workplace, making sure they're maximizing their 401k or their health savings account. So, all right, are you getting the point? All right, I'm almost done with part one of my rant. Point is, working with a financial advisor there's a lot more under the surface. It's just the tip of the iceberg saying, hey, just put it in an S&P 500 index fund and walk away. A real financial advisor who's proactive and comprehensive in their approach can add way, way more value. And that leads me to part two of this, which is the previous episode I did was on financial advisor fees, and I talked about this, and that is the value has to be there. Everybody wants to talk about cost, but cost in the absence of value is just a number. That doesn't help us at all. What value am I getting? There's a great article here from Smart Asset. Yes, you see what they're doing with the name, very, very, very edgy. But they do. This is great research and it's a great article. They what they did is they did a ton of they did a real deep dive on what's the true value, like putting a numerical value on a financial advisor and working with a financial advisor. What does that work out to? And they looked at all these different areas, not just investment management, but behavioral coaching, tax planning, estate planning, health insurance, life insurance planning, the whole gauntlet. How much value can a financial advisor add on average to the average investor? And what they found is that after fees, net of fees, the average annual rate of return increase for people working with a financial advisor is in the neighborhood of 2.5%, somewhere between 2.39 to 2.78% is what the research found. And it's a longer article. I'm just going to try to give you the bullet points on this. Now, 2.5%, I don't know, maybe that doesn't sound like a big number to you. 2.5% is huge when it comes to compound interest. The difference between a 5% average annual return and a 7.5% average annual return is massive. So depending on when they started working with the advisor, what they found is that clients could see anywhere from 36% to 212% more dollar value to their bottom line over their lifetime of working with an advisor. Somewhere between about a third more money to 3 times as much money, which is just crazy. So to give you an example, like a 45-year-old who works with an advisor for the rest of their life, they estimate that the premium, the value added, is about double of their net worth, that they would end with twice as much in net worth as compared to not working with a financial advisor. Again, I'm talking about comprehensive, proactive financial advisor, not somebody who just sells you a financial product and can't be bothered to talk to you unless you call them. Now, advisor fees are typically in the 1% range, and this is after those fees. So this is what I talked about in the previous article, and that is, this whole idea of, all right, well, if you pay, if you just put your money in an index fund versus paying an advisor 1% or a flat fee of $10,000 a year or $350 an hour, well, why would you want to do that? Because you'll have X if you do this, and you'll have way less if you do that. is not a fair comparison. It's actually, frankly, a ridiculous comparison. You have to stack up, okay, what are the values? What are the things that the person would be doing differently and proactively doing on all of these different facets of their finances? And then what is the value of that compared to the fee that they would be paying their advisor over the lifetime? And what this research shows is that on average, again, not in every single case, I'm going to tell you, not every single person needs a financial advisor. All right, I'm not. That's not what I'm trying to say here. But on average, in the aggregate, the value is much, much higher than what they pay a financial advisor, and I've seen that personally in my own practice, and that's what I actually talked about in the last podcast. So there we go. Getting off my soapbox now. Rant over. I find that I need every now and then to just use this podcast as an outlet to try to get that point out there that, hey, there's a lot more to this conversation than sometimes what you see in a social media post. And by the way, a lot of times what you see is people saying, hey, never pay a financial advisor. Financial advisors are ripoffs. And then what's the next thing out of their mouth? Then buy my course, buy my book, follow my social media account. In other words, no, don't follow them for financial advice. I have all the financial advice you need. So almost always there is some angle in it for them. So just please keep that in mind and always make sure that we're comparing fees to value there. All right, getting off the soapbox. Last article, I'll just mention it. President Trump is floating the idea of a $5 million gold card as a route to U.S. citizenship. Several other countries do something similar in that if you have a certain level of financial investment you're willing to make in that country, they will give you a visa or even on a pathway to citizenship or both. And Trump is apparently exploring the idea of doing a similar thing with the U.S. I can see both sides of that argument. $5 million is, again, the number that's being floated out right here. But as we've learned with President Trump, he is definitely not afraid to think outside the box. And he's also prone to change his mind and negotiate and, say one thing and then later it ends up being another. So we'll keep our eye on that. It'll be interesting to see if our visa program gets adjusted accordingly there. Okay, well, that's going to do it for our 5 articles from the month of February. Thanks as always for listening and following the podcast and the YouTube channel, and we'll see you on the next one.